Welcome back to the deep dive. We are looking at a fascinating snapshot of the market right as 2025 is winding down. It's December 29th, and it is defined by this one just bizarre central conflict.
It really is. It's the ultimate paradox of this year end. And our mission today is to figure out why the market is signaling, calm and complacency on one hand, and acute systemic fear on the other.
That's it, exactly. You've got this extreme division.
We're calling it the two markets.
I like that. So on one side, you have U.S. stocks, tech and growth, holding these really high levels. But then on the other side, the classic safe haven assets are also hitting these huge all-time records.
And all of this is happening on thin holiday volume, which just makes the split feel even more dramatic. The market feels both boring and, frankly, terrifying.
Okay, so let's start with the macro picture. We have to. Before we get into specific assets, what's going on with rates and liquidity?
The tension is palpable in the Treasury market. The 10-year yield is stuck. It's in a mid to high range, right around 4.14%.
And 4.14% is, well, it's stubbornly high for anyone hoping for relief.
It is. And it's stuck there because of conviction about 2026. The market is absolutely pricing in a rate cut window for next year.
But the Fed isn't really committing, right? Not on the timing.
Exactly. No commitment on the timing or, more importantly, the size of those cuts. So that lack of clarity is what's keeping the long end of the curve right where it is. It's this belief that things will get better, just not right now.
Okay, so that sets the stage. But it doesn't explain the fear trade. What about liquidity? It's the last week of the year. That has to be a factor.
Oh, huge factor. We look at the Fed's overnight reverse repo, the on-end RRP, and right now, usage is remarkably low. It's sitting around $20.34 billion.
And for our listener, why does that 20 billion figure matter so much?
Well, when it's that low, it's a signal. It tells you the extra cash is being drained from the system. It's a typical year-end thing, banks tidying up their books. But the key is low liquidity means thin order books.
So any big move has a bigger impact.
A much bigger impact. The market is it's highly sensitive right now. Volatility risk is bubbling right under that calm surface.
Which brings us perfectly to this emotional disconnect. This is where the two markets really starts. We have one fear index that says we're all asleep.
And another one that suggests we're in a cold sweat. The VIX, the classic fear index, is low. It's about 13.6.
13.6? That's holiday calm. Complacency.
Total complacency. It suggests in the world of big stocks, risk is being completely ignored.
But then you look at let's say, the younger side of the market.
And it's a completely different story. The crypto fear and greed meter is stuck in extreme fear, maybe 20 or 30 on the scale.
That is a sharp disconnect.
It tells us investors in those more speculative assets are feeling real psychological distress, even while the old guard is just sailing along.
So this split in feeling,
Yeah.
How does it actually show up in the assets themselves?
It leads us right to this great thematic division. Money isn't scattering, it's concentrating aggressively into two, diametrically opposed ideas, AI-driven growth on one side and old-school safe haven metals on the other.
Let's start with the AI story. That's the headline we've seen all year.
Right. The broad indices, the S&P 500 trackers, they're holding their ground. But the real strength, the real power, is all being channeled through AI infrastructure leaders.
The picks and shovels of the revolution.
You got it. And the engine driving all of that is, of course, NVIDIA. Still. NVDA is trading around, 188 to 191 won rubles. The conviction there is just incredible. The market believes the need for more chips, more data centers. It's basically decoupled from the rest of the economy.
It's future-proofing. Investors are paying a premium for what feels like guaranteed growth.
It really is.
But, and this is the big but, if everyone is so confident about the future, why are we seeing the biggest run on safe haven assets in decades? This is the shockwave.
This is where we pivot to the other market. And the headline is just stunning. Spot silver broke $80 an ounce.
$80. That's a new absolute record high. That's not just a rally, that's a flight to safety.
It's a perfect storm. First, silver has huge and growing industrial demand. Think solar panels, EVs, all that tech, so supply is already tight.
But industrial demand doesn't get you to $80. That's hedging, that's fear.
You've hit it. The second factor is that traditional safe haven motive. People are betting on those 2026 rate cuts, which means they expect the dollar to weaken. So non-yielding assets like metals just look more and more attractive.
And gold is moving too.
Oh, absolutely. Gold is continually refreshing its own highs. We're seeing it between 44, 145, 50 an ounce. When you see both moving like this, it's deep.
Yes.
It's concerned about sovereign debt, currency stability, geopolitics, All of it.
So investors are basically making two big bets on the future, one on AI for growth and one on metals, just in case everything else falls apart.
That's the dichotomy. And you can see the results of this even in the digital world. Just look at the Bitcoin to gold ratio.
Which tells a very clear story.
It does. It has dropped significantly this year. It means, in simple terms, that gold has gained a lot of relative strength compared to Bitcoin. When the fear money is running, right now it's running to physical safety.
And that leads us straight to the digital asset space. Sentiment is extreme fear, but Bitcoin is still holding a pretty high range.
The fear is driving cautious consolidation, not a panic sell-off. BTC is holding in the, say, 87K to 88K range, but it's on that super thin volume we talked about. Institutions have adjusted their buying.
So they're not selling, but they're not adding aggressively either. They're waiting.
Exactly, just holding their chips. And you see players like Coinbase hedging their own business, right? They're looking for new revenue streams like prediction markets, beyond just training fees.
What about that really high-risk corner, the pre-stocks for private companies like OpenAI?
That remains purely speculative. I mean, small position risk capital only. You see OpenAI pre-stocks trading in the, $1,030 to $1,120 range. It's pure optimism on private growth, but it's totally illiquid. It's a world away from the fear narrative.
So we've outlined this market, low volatility, but with this massive thematic split between AI growth and a record metals run. For you, the listener, how do you even begin to build a strategy from these conflicting signals?
The main strategy has to be defense first. When the market is pricing in everything and nothing at the same time, defense is key. For your long positions, you stick to quality. Broad ETFs, proven leaders like NVIDIA.
And how you build those positions is just as important right now.
Absolutely. You use phased building, you scale in over time. You do not want to get caught making one big buy in this kind of low volume environment.
And what about that hedge? Do we just pile into gold and silver?
You have to maintain an appropriate hedge, yes. Gold ETFs or physical are standard. You could use small, very carefully controlled positions in silver, but be careful. Silver's volatility is way higher than gold's. It can swing massively.
So what does this all boil down to? We have this final provocative question for you to think about. This decoupling of risk and safety, especially with that falling Bitcoin to gold ratio, it forces you to ask what the market is really anticipating.
Is it predicting, an inflationary slowdown that just ushers in those rate cuts, letting the AI story boom? Or is this record run into physical metals a signal of something deeper? Some geopolitical or systemic risk that technology just can't shield us from?
A smooth landing or mounting chaos? The price action suggests that right now, somehow, the market's answer is both. Thanks for diving deep with us. We'll see you next time.